Good morning and welcome to everybody to the first session of the We Are In conference, session on financial intermediation in banking. We have three fantastic papers lined up for presentation today. Our first speaker is Manju Puri, professor at Duke University, and their paper on digitalization and credit access will be discussed by Paolina Medina from the University of Houston. So Manju, you have 25 minutes, and the floor is yours.
Thank you very much. It's a pleasure to be here. And so let me get straight to it. So the title of this paper is Breaking Barriers to Financial Access, Cross-Platform Digital Payments and Credit Markets. It's joint work with Shashwat, Alok, Pulak, Ghosh, and Nirupama, Kulkarni. And so let's get to what is the motivation of the paper. It's pretty straightforward. 1.4 billion people around the world don't have bank accounts. And even if you have a bank account, it doesn't mean that you have access to formal credit markets. Now, this is not just an emerging market issue. The FDIC, where I was on deputation for 2 years, does a biannual survey of the unbanked and underbanked. And even in a country like the US, depending on the time horizon, the unbanked estimate is in the order of 5%. And underbanked is in the order of 16%. So this is a global phenomenon. And part of this, we know fintech has been rising. And so part of the promise of fintech is that maybe they can get people who never had access to credit access through alternate credit scoring mechanisms. And so I have an earlier paper on digital footprints that suggests even a shallow digital footprint, how you access the internet, what time, do you have an iPhone, et cetera. Information all of us leave behind when we access the web, does as well as predicting default as credit bureau scores. And so this gives us hope. Maybe there's a way for people who have thin credit files to now get access to credit. However, there's little evidence so far, at least in the US, that fintechs have delivered on this promise. And so part of the problem is, there's a cold start problem. How do you facilitate the creation of digital footprints in the first place? And our focus in this paper is going to be, what if we publicly provide a digital infrastructure where you and I can make payments to each other seamlessly, instantaneously, in a verifiable way? Will that improve access to credit? And for this purpose, we're going to study India's UPI. Now, what is UPI? So essentially in India, the government decided that they would build the public digital rails. So it's a public digital infrastructure funded by the government. Once you have these rails, now anyone can put an app on it. It can be Google, it can be Venmo, it can be PayPal, and it is interoperable. What does that mean? It doesn't matter if you have Venmo and I have Google Pay or PayPal, we can still transact to each other. This is not true in the US, right? I consistently have a problem. How do you have Venmo? No. Do you have PayPal? No. Okay, I'll give you cash or I'll write a check. Here, it doesn't matter who you have a bank account with, what app you're working with, you can seamlessly and instantaneously transfer money. And the net result of this is you have a real-time, zero-cost creation of a digital financial history. Now, why is this important? Can you please click on flowchart? So let me give you an example. Let's suppose, the informal sector is large in many developing economies. So think of a bricklayer, right? Or think of a roadside vendor, right? Selling masala tea, right? Now, so Sharda Masala Chai Wali, she sells masala tea. All she has is a broken down card. No bank is going to give her a loan. There's no collateral. There's unverifiable cash flow. So what do? Now, however, enter UPI. And now what has changed is, so I go and I say, hey, I'd like a cup of tea. The cup of tea is $1, okay? So now she says, sure. So I have the QR code. So I put in Sharda Masala Chai Wali, ICICI Bank, whatever the account is. And so then what's going to happen is, so I enter $1 into this. So it goes to the UPI rail, which goes and checks, okay, in this bank? Does she have an account, etc.? Sends the account detail. Then it goes to my bank, let's say Bank of America, checks my account, debits $1, goes ahead, credits Sharda Masala Wali's chai, and then confirms. All this has happened in 2 seconds. So before I can even take a sip from my cup of tea, we're verified. This transaction has happened. It's digitally verified. Can we go back to main, please? And so now what's happened is you move from having basically just a lot of cash, right, to a digitally verifiable cash trail based on which you lend. And so, yeah, sure, you may just have a card and you may be selling masala chai, but you're a hard worker. You work 8 to 8 every day, 7 days a week. You make the world's best chai and you sell a lot of it and at a good price. So you're making, let's say, $1,000 or $2,000 a month. Now this is verifiable. The bank can look at it and say, I can make you a loan of $200. This is cash flow-based lending, right? And so this, right, is known as open payments, where you have interoperability, right, across your payment system and my payment system, which is really fundamentally the key. You're not locked in any app, and you can transfer to anyone and create this digital verifiable history. And so historically, India, like many developing countries, has been a high cash usage country. However, with UPI coming in, that has changed. There's enormous amount of transactions done digitally. Now, to do this, you need a bank account. The other feature we'll see in India is, the banking of the unbanked, which we know is a big issue. Why do people not have bank accounts? So the FDIC survey of the unbanked will say, look, there are 2 main reasons. One, transaction costs. I open a bank account with $100. I don't do anything. After 2 years, there's nothing left, right? Gets debited in fees. Second, you need a lot of documentation. So in India, the Prime Minister's scheme said, look, hey, banks, you need to open accounts for everyone. So 1, these are going to be zero-fee accounts. 2, if they don't have the documentation, you open it, and then, hey, banks, you are responsible. Make sure within 6 months the documentation is regularized. As a result, 99% of India is now banked. Now, importantly for us, we can identify where these bank populations are, these JDY accounts. And we can see, is there a differential effect for previously unbanked people? The answer is going to be very much yes. So essentially, we're going from cash transactions. History, think of my Sharda Masala Chai Wali, can't get a loan from the formal sector, has to go to the local moneylender. But now you have digitally verifiable revenues. And so now the bank or a fintech can say, fine, I will make a loan of $200, $300 because I can see cash flow-based revenues of $1,000 to $2,000. Okay, and so this is the question we're asking. That India has this very unique digital platform, right? India is now, the 4th largest economy in the world. And I've been working now in fintech for about 10 years. So whenever I go for these conferences where you have both academicians and policymakers, there are always 2 players who are there. One is Google, and the second is India's UPI. Everyone wants to know what's happening here. Bill Gates goes to India to check it out. Why? This is a massive, massive experiment. And if it works, it's a template that others can follow. So we ask, when you have these digital rails, do you improve access to credit? If so, to who? On the intensive and extensive margin. And importantly, what about people who never have access to credit before? Do they start accessing credit? And if so, where is this credit coming from? Is it banks? Is it fintechs? Is it both? To which subsector? And how does the distribution sort of change? So let me give you a quick preview of the results, since my time is short. So the short answer is increase in credit across the board, right? To everyone, prime, subprime, new to credit. Everyone is giving more credit, both the fintech and the banks. A rising tide sort of lifts all ships. Everyone is getting it. However, who is giving credit? Banks and fintechs respond differentially. Banks are more likely to give credit to prime. The risky borrowers, people, the new to credit, getting credit from fintechs. Fintechs are leading the charge. Complementaries matter. You need to have access to good internet and cheap internet. We're going to look at the rollout of Jio, which gave India very, very cheap internet access, to see if you actually see some of these effects. The answer is yes. We're going to look at previously unbanked people, where you know the JDYs, and we're going to find they also differentially get more access to credit. And then you might ask, well, all this extra credit, are we just going to have defaults through the roof? So we check for that. You don't actually have higher defaults. Now, why should an open digital payment infrastructure affect credit? Well, theoretically, it can go either way. On the one hand, you know, banks are a traditional supplier of credits. This is breaking their monopoly power. And so maybe their competitions, you have fintechs who are young, hungry, and nimble. And so maybe you're going to see an expansion in credit. And so what happens is an empirical question, and that is what we're going to look at. So we say this is the first large sample study. Really, this is using the whole of India. We have the universe of data from Credit Bureau, not 5%, 10% from TransUnion, as we have in the US. We have 100% from TransUnion in India. And so we can actually see who never gets access to who does, and, you know, and we're going to take advantage of that. And as I said, you know, why India? It's a massive, bold experiment, right, that everyone has their eyes on, worthy of investigation, right? We need to know what are the results. So let's look at UPI. Average Indian, average, not professors, not high-tech guys, average Indian consumes 24 gig of data a month. When they see my internet plans, they laugh, right? Because it's so expensive, right? And data there are like 7 cents or something, right? It's incredibly, incredibly cheap, right? Okay, so this is how UPI transactions have grown. So you can see it's a hockey stick, right? And we have to collect a ton of data to figure this out. So we are going to get lots and lots of data. Our main source is going to be the credit registry. Importantly, from the point of view of financial inclusion, we know who has never got access to credit. We can control, are you prime, subprime, et cetera. We know who is the lender. Is it fintech or is it a bank? And you know, we know the amounts, number of accounts. We're going to, I'm not going to go through all the data, but there's a ton of other data you need to mix and match. We're going to need UPI data. We're going to need branch deposit data. We're going to need to know about these JDY or previously unbanked people. To do our experiment on telecom rollout, we're going to need data on the 4Gs, et cetera. And so we have all of this, and we combine it together. If you remember nothing else, remember this graph. I already showed you UPI transactions up like a hockey stick. And as UPI transactions are going up, look at what's happening to credit, right? For every 1% increase in UPI payment, there's a 0.7% increase in loan amounts. This is so strong. It's so massive. I'm going to do 3,000 different tests. It's not going to matter. Importantly, though, lenders behave differently, right? And so let's look at the difference between fintech and banks. Now, fintechs are, of course, close to zero at the beginning, and they've grown. And you can see, you know, they've grown a lot. And they cover all categories. But if you look at the new to credit, right, which is the bottom sort of light blue, it goes to zero. The new to credit now done by fintechs is the same as the total that is done by banks. Banks have not increased it. Fintechs have come in and taken this over. So let's look at how do we identify this and estimate it. Now, in order to use UPI, you need a bank account, right? And so when UPI is introduced, banks have to sign on. Some banks sign on early, some banks sign on late. So we're going to take advantage of this early versus late sign up, right? And so this is sort of used in Dubai and Puranandan. We're going to take that and expand on it, right? And the idea here is, so let's suppose we're here at, at the ECB, and all the banks around here signed up for it. Then the exposure is going to be 100%. If no one signs up, it's going to be 0. If half of them sign up, it's going to be 50%. So we're going to use that as a continuous measure at a very granular level, at the PIN code or the zip code level, and we're going to do it by deposit share, right? Now, you might ask, well, maybe, some banks, certain kinds of banks sign on early. But remember, if you sign on, you can't choose to sign on in some areas or not. If you're a national bank, you're signed on everywhere. And so we do a balance test again, right at the PIN code level for all kinds of differences in economic and other activity, and we don't find any difference, right? And so we're doing this at a very granular level, which is the PIN code or the zip code level. And we're going to control for time-varying local factors using district-month fixed effects. We're going to go even further, right? And so we go even more granular. There are 2 ways to do it. That is, you can divide the map into grids. So let's suppose I take the ECP, this area, and now this becomes a grid. And within that, there's one area where the banks all signed on for UPI and the other where they didn't. I'm going to look at the difference. The argument is going to be we're across the road. Any other economic shock should be common. The only difference is, banks here signed up for UPI and there they didn't, right? So we're going to look at these very narrow geographic areas and see, and our results are going to go through. Alternately, you can take the boundaries of PIN codes, zip codes, and look on either side where there's high and low. It'll reduce the sample size, but the thought experiment is similar. Very, again, similar results. Okay, so the first thing is we're just going to look at UPI transactions on the left-hand side and look at our UPI exposure measure on the right-hand side as a reality check. And it's exactly the way you want, right? And that is if the exposure is higher, right, more banks have signed on, you're going to have a ton more UPI transactions. We're now going to look at credit access. So the left-hand side is going to be the total number of loans, or we also do loans per capita. On the right-hand side, we're going to have our exposure measure, all these district month year, PIN code, fixed effects. We're going to cluster at the PIN code level. We're going to look at differences between fintechs and banks. And so here, are the coefficients, for fintechs. So you can see it's sort of flat before the introduction, and after that, it's like a hockey stick. Same thing for banks, right? This massive growth after UPI is introduced. So it is clear UPI is a game changer. The question is for who? So we now are going to run all those regressions. So each coefficient here is coming from a regression, right? So I'm going to divide into prime, subprime, and new to credit. I'm going to run this separately for fintech, separately for banks. And you can see how all the numbers, except one, are sort of positive and pretty big, right? What this is saying is that if you look at fintech, 26 times the number of loans per capita, right? And banks, it's 16%. Now, take it with a pinch of salt, because remember, fintech start at a base of 0, so it's not quite correct to just say the number. But if you look at the absolute amounts, right, as I showed you, new to credit by fintech is now the same as what banks are doing. And new to credit banks, 0 increase. That's not where banks are going. They are doing their lending more to prime borrowers. So again, now, let's look at the regressions. And this is just putting it, the whole thing there so you can see. And so you can see here all the numbers, new to prime, subprime, prime, positive and significant. Everyone is getting more credit, but from where? So fintech, again, everything is significant. When you do banks, the new to credit is insignificant, right? It's far more significant. Prime is the biggest one, right? Lots and lots of robustness checks, as any good paper has to do these days, right? We do the grid time, fixed effects, which I explained. We do the neighborhood pairs, which I explained. We've used so far the continuous UPI measure. We do a binary one, which we explained. Then India at this time underwent demonetization. Could that have an effect? Now, our tests actually capture that, right? Remember our little grids? So if there's demand, right, whether you're across the road, I'm here, we should be affected the same, right? So the only difference is the high and low UPI exposure. Nonetheless, we do an additional test. We control for variation in cash availability. So it's from the nearest currency chest that other people have used to proxy for the demon effects. We find very similar effects. Then let's look at complementarities. So what have we found so far? UPI increases lending. Now, but to do these digital trails, you need to have good internet, not just good internet, cheap internet. And so Jio, launched by Reliance, they sort of said, we're giving dirt cheap internet. And they launched lots and lots of 4G towers. We're also going to look at the previously unbanked or the JDY accounts. So let's look at Jio. So this is the way Jio rolls out towers. So you can see massive increase in the 4G towers. And this is what happens to the coverage in India. Spotty in 2016, covered densely by 2020. The average distance to a tower goes down from 15 kilometers to 2 kilometers. Normally, if you're within 4 or 5 kilometers of a tower, you have very good coverage, right? And look at the cost of data, less than 10 cents a gig, right? And so now we look at what is the effect of credit, and you can see, you can see the complementarities both for fintech and for banks. So you can see with fintechs, when Jio comes in early in an area, right, you see much more credit across the board. The same thing with banks, again, insignificant for new to credit, but significant everywhere else. We again do robustness. We look at, well, what if you have internet, but it's expensive? This is non-Jio operators, and compare. And it really is good but cheap internet that is driving this. We also then look at formalization through having bank accounts. Our JDY are the previously unbanked people. So again, we look at what is the effect of access of credit. And you can see where you have a lot of JDY accounts. So this is where a large amount of previously unbanked population, you actually see a higher effect of UPI coming in, right? And this is particularly, again, significant for fintech, not for banks, right? And so the risky, new to credit borrowers, fintech leading the charge. Now, how much are we talking about? So far I've been telling you number of loans. Let's aggregate this into the aggregate amount of credit. This is what we have. Let me put the interpretation. 1.99 million increase in low value and high exposure PIN codes. So that's economically about a 22% increase relative to the pre-treatment mean. So that's a difference. There is a big difference in the ticket size between banks and fintechs. Fintechs do these small ticket items. The average size is about $200. Banks, it's 9 or 10 times of this. This makes sense. Banks are risky. Banks are regulated. They have the examiners on their back. They don't want to do these small ticket risky loans. Fintechs are happy to do it. They're the new entrants. They're nimble. Their transaction costs are low. They come in and sort of eat up this segment. You might ask, what is the impact on default? And clearly, riskier loans are going to default more. So that's not the right way to look at it. What we should look at is controlling for risk. What is the difference in default between making loans by the old technology and the new technology? And you can see when we do that, it really is nil. And when you do it in the multivariate, it's either zero. If anything, you're marginally decreasing defaults. You certainly are not increasing defaults. OK. And so that's separately for fintechs, separately for banks. Let me conclude, right? 850 million people in India either do not have access to credit or not to enough credit, thanks to thin or non-existent files. This is a global phenomenon. And so first order question is, how do we expand access to formal credit to the marginal population? Can a cross-platform, seamless sort of digital infrastructure help? And using the full universe of the TransUnion or the credit bureau data in India, we find the answer is yes. Everyone gets more credit, but particularly the underserved, particularly people who never have access to credit. It is fintechs leading the charge. And not only this, people who previously never had access to bank accounts, it's again fintechs expanding credit there. We find these effects are stronger when you have cheap and good internet connectivity. And importantly, this increase in credit is not resulting in higher default rates when you control for the credit rating, right? So if anything, the new technology, is marginally getting you better, better results, certainly not getting you worse. And I think I'm right on time, and so thank you.
You have 10 minutes.
Yes, thank you. All right, well, good morning, everyone. Thanks to the organizers for inviting me to discuss this paper that I very much enjoyed reading. And while we wait for my slides to come up, yeah, I can tell you that at a high level, this paper is asking the question of whether the diffusion of payment technology can equalize access to credit, or if instead it's going to deepen existing inequalities in access to credit. And the authors do that in a way that combines micro evidence on lending to speak to a macro question of financial inclusion and payment system infrastructure. And to see that, let me start by telling you a little bit how traditional lending technology works, and simply by emphasizing that traditional lending technology relies heavily on credit histories for credit origination and pricing decisions. Nevertheless, a large fraction of the population around the world simply lack credit history. When a lender faces individuals without credit history, they don't have a technology, they cannot use their technology to distinguish good payers from bad payers, and often they end up rejecting these applications of approving them with unfavorable terms relative to their true credit profile. And in theory, alternative data could eliminate the cycle of exclusion that arises from having no history, no credit, and no history. In principle, alternative data could break this cycle, and that has been at the center of an active literature pioneered by Manju, and in which I also have the opportunity to work on, that shows that alternative data can be a complementary or even an alternative input for credit scoring technology and can lead to credit scores that are as precise as those calculated with traditional data. However, credit scoring, which is at the center of that literature, is not the same as credit access because there are many reasons why banks may not use this technology to expand access. On the one hand, it may be more profitable for banks to offer more credit or better credit to individuals that already have access. At the same time, it could be that maybe these credit invisibles could organically get access to credit over time, just making this technology less impactful or to expand access to credit, or maybe the barriers to adoptions are so high that banks would not use it. That's why this is inherently an empirical question that Manju's papers try to address, and they do that by taking estimating the treatment effect of UPI adoption on access to credit. For identification, they exploit that some banks adopted UPI earlier than others, and they basically compare the number of loans in PIN codes that have where these early adopting banks have low market share to the number of loans in PIN codes where these early adopting banks have high market share in the deposit market before and after 2016. And what they find is that indeed, This is a story about expanding access and not only giving more and better credit to those that already had access. And they find effects that are in the order of magnitude, if we look specifically to new credit to fintech by fintech companies, between 5% of the mean or even 16% of the median, because it's this very skewed distribution. So overall, I think there are many things to like about this paper. It's clearly a first-order question that has a lot of economics into it. So my comments are going to be focused on two things. First, potential mechanisms behind these treatment effects, and second, the dynamics of how access to credit evolves when this technology is introduced. My first comment is about what UPI brings in to the table. And the first thing that comes to mind is what can be called a sort of verifiability effect that arises because some transactions that were going to happen in cash are now going to happen with a digital payment method that leaves a trail, and that can benefit merchants and customers in different ways. On the one hand, for merchants, now we have clearly verifiable income, which is what Manju was referring, and which is cash flow-based lending. Alternatively, consumers may also be leaving a trail of their spending patterns that can be an input into these sophisticated machine learning methods for credit scoring technology. But as I was reading the paper, another mechanism that came to mind is something that I was reminded from the typical premise on payment, the economics of payment systems, which is that accepting digital payment methods is actually a competitive tool for merchants to increase volume. That is to say, in this context, I'm a merchant, I'm a street vendor that's selling masala tea chai on the streets, and as a consumer, I may go to the vendor that accepts UPI instead of going to the vendor that doesn't accept UPI because it's more convenient for me to make that transaction. This is an important distinction because, in a way, these two channels have different policy implications. If the story is indeed about the verifiability of transactions, then the emphasis going forward needs to be focused on data sharing standards and how do we make this type of information available to more lenders. If the story is more about volume effect, we're in a situation in which increasing the revenue that merchants have is equivalent to increasing the income in this population that can in itself have impact to access to credit through different mechanisms. But the good thing is that I think the authors have very rich data that can allow us to understand at least how important these alternative mechanisms are. On the volume effect, I want to emphasize that I'm not talking about a confound that is biasing the estimates, because as Manju mentioned, they have very rich data, very rich specification that is very convincing that this is not a story of an unobserved shock, but we're talking about this being a treatment effect to UPI adoption. And the authors can simply change the outcome variable and see if UPI adoption is also increasing the income of these street vendors that now can clear more transactions because of the convenience and the competitive edge of accepting UPI. And on the verifiability side, I think it will also be important to better understand if this is a story of cash flow-based lending or if this is a story about sophisticated machine learning by which consumers leave a lot of information about their spending patterns. And one quick way that someone could get at this is by seeing if the story is different in areas when there are a lot of incoming transactions that will be more indicative of cash flow-based lending, or more outgoing transactions that will be more indicative of consumers revealing their spending patterns with their transactions. And a final point to that end, related to opening up the number of UPI transactions in a PIN code, is that it would be interesting to know how many transactions do you need to be scored. And in some of the work that I have the opportunity to work, we know that you don't need a lot of transactions to be scored with a lot of accuracy. And in that sense, I wonder if the number of UPI users in a PIN code would also be informative to see if it's just about using UPI. It's not about how intensely you use UPI. that can inform the type of data sharing that we want lenders to have access to? Do you need the entire transaction history, or is it enough to just give you access to your cell phone and the more shallow digital footprint that comes when you download any of these UPI apps? And my second comment is about the dynamics of treatment effects. This graph that Manju shows us, we can see that treatment effects grow over time. I find it very interesting that given that the identification is so rich and ultimately is comparing even neighboring PIN codes with high and low baseline levels of early adopting banks, I would have expected that the spillover effects would spill to the neighboring PIN code. And if that were the case, maybe we would expect a flatter dynamic. Yet again, the data the authors have is so rich that allows very clearly to test whether that is the case or not, because I would be very curious to see if UPA use follows that same dynamic as the treatment effects in neighboring PIN codes. It could very well be the case that in 2 years of history, the early start of early adopting banks survives, and this is the dynamic of UPI transactions. I think that would really help to justify these increasing dynamics in access to credit. Overall, I think it's a great paper that speaks to this first order question of whether this new scoring technology is indeed expanding access or alternatively widening credit disparities. I'll be curious to learn more about these mechanisms that I mentioned and about the dynamics of UPI use. Thank you very much.
Yeah. So Manju, would you like to take a couple of minutes and then we respond, and then we open the floor for questions?
Thank you very much for that discussion. So I'll just very briefly respond. You know, I think you raised some good points. Like, the first is, what is the mechanism? And in our mind, I think it's quite clear that the mechanism is different across different segments. So when I'm looking at prime, they already have access to credit, and yet they're taking on more credit. Why so? So I'm thinking it's people like you and I. You go to buy, let's say, a refrigerator. Normally, you wouldn't take a loan, you know, a couple of $1,000s, but now the transaction costs are about zero to do it. You can push a button on your mobile, and 5 fintechs and 6 banks will tell you, we'll give you a loan at this maturity, at this interest rate, very easy. And this is also why these are now small ticket items that we're seeing. But the dynamics are very different for people who never have had access to credit. And so there, it's how do I even have the, once I have the digital trail, you're right, then the distinction is, you know, is it volume, is it machine learning? I didn't even have a digital trail before, right? So we moved from zero to having a digital trail, which is enabling it, right? And so first you can see the cash flow. Maybe if you're a fintech, you know, as my paper and your paper has shown, you can do more of this alternate credit scoring mechanism. But importantly, you need the digital trail. That's first order, and that's what we are establishing. Now, in answer to your question, we do have a test, which is actually in the appendix, where we get data from a single very large fintech to see how are they doing it, right, for these roadside stalls. And what you see is, you know, the more the UPI QR codes, the higher the internal credit score, the bigger the loan, the reduction in interest rates, right? Very consistent with sort of this cash flow based lending. But, you know, to be clear, in our paper, we're saying creating the digital trail is first order important. Once you do that, you automatically see access to credit. Now, on the dynamics, you have to be very careful, right? Why? Eventually, at some point, everyone has adopted UPI, right? And so really what we are doing is we're exploiting the early differences. If you go long enough, and like today, everyone has it, so you know, you're going to see effects everywhere. And so we're exploiting the early differences, and you have to use your bank account. So even if you're just across there, I don't have a bank account, I can't use it, right? Unless eventually I shift my bank account, right? Or eventually my bank signs on, et cetera. And so at some point, you know, it is going to equalize, but that's sort of what we're taking advantage of.
Thanks a lot. Let's open the floor for questions. So I see one over there.
Thank you, Philip.
Oh, please stand up and say your name and affiliation. That's
okay, thank you, Philip Hartmann from the ECB Research Department. So a very interesting paper, very impressive, both the experiment in India and the research about it. Two quick questions. So for my understanding, like what happened after 2019, like this is an experiment. So, but like from your knowledge, what happened after 2019? Because I saw this data stopping 2019-20 something around. So what happened around there is like, did it plateau? The hockey stick became the back of the elephant, or something else? And the other is that sorry, I lost my. Sorry, excuse me. I stick it.
We'll take a few questions and I'll answer.
Yeah. Front row.
Thank you so much. Juanita Gonzalez Uribe from London School of Economics. Great paper, Manju. Two questions. One, do you know anything about prices? I'm interested in whether the business model of banks and fintech also kind of changed around that time. Are you just given more out loans but at a lower price? And finally, how does that affect the competition between banks and fintechs?
Hi, Christina Molnar from Norwegian School of Economics. I'd like to broaden the perspective a little bit, ask about a bit of macro implications, following on the discussion of Paolina. So from the household's perspective, do you see any evidence of their consumption demand increasing? Because it's not only switching from cash to digital, but being less credit constrained because of this new financial innovation. And then, of course, that can have macro implications for with increased demand and so on and so forth.
There's a question over there.
Hi, Refet Gürkaynak, Bilkent University, and this month ECB. Wonderful work, thank you so much for this. This treats the entire being unbanked and cash dependent as being external to these people. So once they had the opportunity, they changed. But you also used the word informality in your presentation, and I would have assumed some of these people actually chose to be outside the system. So once you create this digital payments trail and a revenue trail, of course it makes you more eligible for borrowing, but it makes you very much eligible for being taxed as well. And I would like to know, A, do we see a taxation impact of this? And B, is there a selection? Is it a group of people who actually chose to enroll in this and some other people actually chose to be informal?
Is it okay if we take one more question? Because I saw some more hands on this side. Yeah, there.
Thank you. Irina Steven from the University of Hamburg. I have a question following on Christina. She talked about consumption implication, but also what is about income implications. And overall, you should see huge boost of the economies, right, in this couple of years. Do we see something at the macroeconomic level? Thank you.
Yes, Hélène, yes.
Take the opportunity because the mic is right here.
Yes.
No, so I had a question on econometrics. Did you try the Duchesne-Martin Aufeuille estimator? I don't know if you know about the staggered adoption, because as you mentioned, there is this dynamic effect of in the treatment. And then because there's a lot of discussion on stable coins, and it goes a little bit in the direction of Refet's question. So it seems like the UPI has, a major positive advantage compared to stablecoin, which is precisely this trail in order to get credit. So how do you see? So therefore, do you see that in India, stablecoin have any future or not because of that, or do you think that this kind of avoidance, not wanting to be recorded kind of motive would be an important motive of adoption?
Okay, so can I?
Yes.
So thank you. Let me answer the questions in the order that was raised, right? So we stop at 2019. Why? COVID is coming in, and you're going to see all kinds of confounding effects. We also want to look at, the early versus late. It's very clean. At some point, you go into 2022, 23, everyone is going to adopt it. So it just seemed that was a natural stopping place so that we can sort of get clean we can do clean tests and not worry about the confounding effects of COVID. Then Hunita asked about the pricing and the price data. So when we have data from the single fintech lender, which is in the appendix, right, there we can look at interest rates. And there you do see, you know, as the number of transactions and as the size per transaction goes up, right, interest rates go down, internal credit scores go up, loan size increases, all very, very, very consistent with cash flow based lending, right? You have more cash flows, you're a better credit risk, and therefore, you know, the pricing is better. And while, you know, you're looking at competition, it is becoming increasingly clear that fintechs and banks are catering to different segments, right? Everyone is competing for prime, right? And banks historically have been serving them. Fintech are still getting some of that market, but banks certainly love prime. But the new market, right? These guys who never had access to credit, who didn't have bank accounts, who are risky, fintechs are taking the lead. So you're seeing that now. So fintechs have less competition from banks, but fintechs certainly compete against each other, right? And so, you know, I think that's what you're seeing in the marketplace. Then there were two questions on the macro implications or the real effects, which I think is a very good question. It is not something we study, but it is something that others have studied, in particular, Dubai and Puranandam. They look at, using very different data, they're using survey data, to look at, you know, what is the real effect of UPI, right? And on some of the kind of things that you mentioned, and they are finding, like, in general, a positive.
Thanks a lot for the excellent presentation. Thanks you all for the discussion.